fundamental shift in India's economic policy is underway. As of September 2025, the Indian government has launched GST 2.0, a comprehensive tax reform that could reshape manufacturing competitiveness and consumer pricing across the nation. This integration with the Make in India initiative represents potentially the most significant economic policy change of the current administration. I'm going to provide you with a complete analysis of what's changing, who benefits, and what this means for India's economic trajectory. The implications extend far beyond simple tax adjustments. Welcome to SKRS channel, your source for in-depth economic analysis and policy insights. If you value comprehensive coverage of India's economic landscape, subscribe now and enable notifications for our latest policy breakdowns and market analysis. The Make in India initiative, launched in 2014, set ambitious targets for manufacturing sector growth. The objective was clear: increase manufacturing's contribution to GDP, attract foreign direct investment, and establish India as a global manufacturing hub. However, manufacturing's GDP share has remained relatively stable at approximately 17%, indicating that structural challenges persisted. The Goods and Services Tax implementation in 2017 aimed to create a unified tax structure, replacing multiple indirect taxes. While successful in broadening the tax base, GST 1 presented complexity issues: 4 primary tax slabs, numerous exemptions, and compliance burdens that particularly affected small and medium enterprises. This complexity hindered the seamless business environment essential for robust manufacturing growth. What is GST 2? GST 2, effective September 22, 2025, represents a fundamental restructuring of India's indirect tax architecture. The reform centers on 3 core changes. First, tax slab rationalization. The system transitions from 4 primary slabs to a simplified 2-slab structure, 5% and 18%, covering the majority of goods and services. Second, significant rate reductions. Approximately 99% of items previously taxed at 12% are moving to the 5% bracket. This includes essential consumer goods, electronics, and manufacturing inputs. Simultaneously, 90% of goods in the 28% bracket are being reclassified to 18%. Third, introduction of a 40% rate exclusively for demerit and luxury goods, tobacco products, premium automobiles, and high-value luxury items. The strategic alignment with Make in India is evident. Reduced input costs enhance manufacturing competitiveness, simplified compliance reduces operational overhead, and improved price competitiveness strengthens both domestic and export market positioning. This creates a foundation for sustainable manufacturing growth that previous policy iterations struggled to achieve. Sector-wise impact. The sector-wise impact analysis reveals significant implications across key economic segments. Consumer goods sector, household essentials, personal care products, and electronics see immediate price reductions. For an average household spending Rupee 50,000 annually on these categories, savings could reach Rupee 4,000-6,000. Automotive sector, particularly beneficial for hybrid vehicles and compact cars, enhancing affordability and supporting the government's sustainable mobility objectives. Textile industry, India's textile sector gains substantial competitive advantage, with reduced input costs improving export margins and domestic market competitiveness. Manufacturing inputs, raw materials, components, and intermediate goods experience significant cost reductions, creating multiplicative effects throughout manufacturing value chains. This creates positive economic momentum. Lower production costs enable competitive pricing, increased demand stimulates production scaling, employment generation follows, and economic growth accelerates through this virtuous cycle mechanism. Benefits and risks. Comprehensive impact assessment reveals both opportunities and challenges. Structural benefits include immediate consumer price relief, enhanced manufacturing competitiveness, simplified tax compliance reducing administrative costs, improved export competitiveness, and accelerated formalization of the economy. However, significant risks require monitoring: short-term revenue reduction for both central and state governments, potential implementation challenges during transition periods, possible inflationary pressure in excluded sectors, and uncertainty regarding business pass-through of cost savings to consumers. Economic research suggests that successful implementation depends on effective monitoring mechanisms, coordinated state-level execution, and business community cooperation in translating cost reductions into consumer benefits. The medium-term success will largely determine whether this reform achieves its intended economic transformation objectives. What this means for you. Practical implications vary by economic participant. Consumers should monitor price trends in regular purchase categories, expecting gradual reductions over the implementation period. Budget allocation can potentially be optimized as essential goods become more affordable. Small and medium manufacturers face unprecedented opportunity. Reduced input costs improve margins, simplified compliance reduces operational complexity, and enhanced competitiveness enables market expansion. Employment seekers should consider manufacturing sector opportunities, as improved cost structures typically correlate with employment generation. Key monitoring indicators include state-level implementation speed, specific product category price movements, and India's manufacturing export performance in global markets. Your perspective on these policy changes is valuable. Which sector or product category do you anticipate will see the most significant impact from these reforms? Share your analysis in the comments section. If this comprehensive breakdown provided valuable insights into GST 2 and its Make in India integration, please like and share this content. Subscribe to SKRS channel for continued in-depth economic policy analysis and explore our Culture Values Responsibilities playlist for more comprehensive policy examinations. Our next examination focuses specifically on automotive sector implications, detailed analysis of pricing impacts, market positioning changes, and competitive dynamics. This analysis will provide specific data points and projections you won't find elsewhere.